Today I will explain you some basic concepts of macroeconomics. These basic concepts are very essential for the study of macroeconomics. Without knowing the basic concepts, we cannot study macroeconomics, we cannot understand macroeconomics. So the basic concepts that I am going to discuss today here are normal residence, domestic territory, factor income and transfer income, consumption goods and capital goods. The first topic that I am going to discuss here is normal resident. Normal resident refers to an individual or an institution who ordinarily resides in a country and whose economic interest lies in that country. So if any person is coming from other country or if any institution of other country is coming into our country, then these two conditions must be satisfied for it to become a normal resident of India or normal resident of any country. It must continuously stay in that country for more than 1 year, that is a period of 12 months. The second condition is its economic interest must lie in that country. Means it must perform economic activity there, it must earn money and it must earn its living. If these two conditions are satisfied, then the individual or the institution can become a normal resident of that particular country. Now we come to citizenship. This citizenship is a legal concept. It is a legal concept because this citizenship is given by law of the land. If a person is coming from another country and he wants to acquire the citizenship of this country, he have to apply to the court of law and he will get that citizenship from court of law. So that is why it is said that it is a legal concept. While I was talking about normal resident, this normal resident was an economic concept because there the person was performing an economic activity and he earned his living. So that was an economic concept. So as I was talking, citizenship is a legal concept. Then who can be a citizen of India? Again here two conditions are there. If a person takes birth in this country, that is in India, then he is a citizen of India by birth. There is no need of any certificate. He is citizen of India. But if a person is taking birth outside and he comes to India and he wants to acquire the citizenship of India, then he have to get that citizenship from the court of law. He have to apply for that and he have to get the certificate of citizenship from the court of law. The next concept is factor income. I have explained in my previous videos what are factors of income and what are their rewards. So here, when we talk about factor income, it is the income received by the factors of production for rendering their factor services in the production process. When any goods or services are produced, land is used, labor is used, capital is used, and entrepreneur, his skills are used. So, when these factors are used, these factors are paid reward for that contribution. That is, land gets rent, labor gets wages, capital gets interest, and entrepreneur gets profit. So, these factors, when they receive their rewards, that is called your factor income. On the other side, when this payment is made by the producer or the manufacturer, that will be a factor payment for the producer or the manufacturer. So in his books of accounts, he will record as factor payment, whereas these factors will record it as factor income because they have received the money, they have received the reward. The next concept is transfer income. It is the income received without rendering any productive services in return. These are unilateral payments or unilateral incomes, we can say. Like old age pension, scholarship, unemployment allowance, pocket money. All these are examples of your transfer income. These are the incomes received, but for that income received, no productive service have been rendered. So, we can say, without expecting any return, the other party is making payment of this transfer incomes. So, transfer income is only the income received and nothing is rendered for that income received. The taxes received by the government are transfer incomes for the government. We are paying the taxes, but we are not getting anything in return. I mean, specifically, we are not getting. I pay tax, but I am not getting anything in return. Government will use it for the entire society. So, that is a transfer income for the government. In the same way, subsidies provided by the government are transfer payments for the government because it is an expenditure for the government. And on return of these subsidies, in return of these subsidies, government is not expecting anything. The next concept is consumption goods and capital goods. Consumption goods are those goods which are consumed by the consumers directly to satisfy their wants. A person feeling hungry will eat something. A person feeling thirsty will drink water. These are consumption goods. In the same way, in our day-to-day life, we use so many goods. That may be soap, that may be shampoo, that may be rice, that may be wheat, that may be refrigerator, or that may be television. Our clothes, footwear, all these are consumer goods. Then these consumer goods are classified on the basis of their period, on the basis of their usage. They are classified as durable goods, semi-durable goods, non-durable goods, and services. I have explained these things very clearly in my video classification of goods. Then, when we talk about these capital goods, these are the goods which are used for further production of goods and services. Here, all the machinery, all the equipments, all the tools, they come under your capital goods. These are used again and again, and these are used for producing goods and services, by which the firm may make money, the firm may earn profits, the firm may earn revenue.